All right, let's dive into a financial product you've probably heard about, maybe seen commercials for, the fixed indexed annuity. We're going to cut right through all the noise and the marketing hype to give you a really simple, clear guide. Perfect if you're hearing about this for the very first time. So, you've likely seen the ads or heard the pitch, right? It sounds almost too good to be true. Get all the gains of the stock market with absolutely zero risk. I mean, who wouldn't want that? It sounds like the perfect investment. But is it really that simple? Is that the whole story? Well, let's peel back the layers and take a good look at how these products are actually designed and what you can truly, realistically expect from them. We're going to start by tackling that main idea head on, this concept that you can somehow capture all of the market's incredible upside without having to worry about any of its downside. So, what in the world is a fixed indexed annuity, or FIA? The single most important thing you need to grasp is that it's an insurance contract, not an investment you'd buy from a stockbroker. And here's the key. Your interest is credited based on a market index, like the S&P 500, but, and this is crucial, your money is never directly invested in the stock market itself. Now, because it's an insurance contract, your principal, the money you put in, and any interest you've already earned are contractually protected from any market losses. That means if the market kinks, you don't lose a dime. That safety, that's the core benefit right there.
Okay, so you're probably thinking, if my money isn't in the market, how does it grow with the market? That's a great question. And it all comes down to the insurance company's clever strategy behind the scenes. Let's break that down.
Here's how they pull it off. When you give them your premium, they take the vast majority of it, like 95% or more, and stick it into super safe investments, like high-quality bonds. Your money is safe. Then they take a tiny slice of the interest they earn from those bonds and use it to buy what are called options on a market index. Just think of those options as a lottery ticket that pays off if the market goes up. If it does, you get credited with interest. And if the market goes down, well, all they lost was that tiny bit of interest. Your original principal is completely untouched and safe.
And this, right here, is the fundamental trade-off with every single FIA. There's no free lunch. You get that incredible, powerful guarantee against any market loss, zero downside. But in exchange for that safety net, you have to give up the potential for those full, uncapped, explosive gains you might see from being directly in the stock market.
Okay, so what should you really expect in terms of returns? Let's push all the hype aside and just look at what the numbers tell us over the long haul. You know, for a well-designed FIA, from a really solid insurance company with good index choices, a realistic average annual return over a long time horizon is typically going to land somewhere in that 4 to 7% range. Now, that's not the 20% you might get in a huge bull market, but it's a solid, moderate rate of return with that foundation of safety underneath. But, and this is a huge but, not all FIAs are created equal. Not even close. If you end up with a poorly designed contract, especially one that uses some of these complex, unproven indexes, your long-term returns could easily drop into that 2 to 4% range. That's why your choice of the specific product is absolutely crucial. And the index you choose matters a lot. On one side, you have the good old traditional indexes, like the S&P 500. We have decades of real-world history with them. On the other side, you'll see these newer, engineered or proprietary indexes. They can look amazing on paper, but they often have these hidden volatility controls that act like brakes. The minute the market gets a little bumpy, the brakes slam on, which can really limit your gains in the real world. For the most reliable and transparent growth potential, sticking with those proven traditional indexes is almost always the safer bet. So, knowing everything we've just covered, how do you figure out if an FIA is actually a good fit for your financial plan? Let's run through a quick little litmus test. This is really the best way to think about it. An FIA is not meant to be your entire portfolio. It's a very specific tool designed for the safe money portion of your retirement, the money that you absolutely positively cannot afford to lose if the market takes a nosedive. This little checklist breaks it down pretty clearly. An FIA is probably a great fit if your number one priority is protecting your principal, if you're close to or already in retirement, and you're maybe looking for something better than low-yielding bonds or CDs. On the flip side, it's probably not a good fit if you're trying to get stock market level returns, if you have a high tolerance for risk, or if you need to be able to access all your money in the short term, because these are long-term contracts. Seriously, if you take away just one single thing from our chat today, let it be this. A fixed indexed annuity
is a bond alternative, not a stock alternative. Its job is to provide stability and modest growth with protection. It's not designed to shoot for the moon.
Okay, finally, let's talk about what is maybe the most important step in this whole journey: comparing your options. This is truly what separates a successful outcome from a really disappointing one. You see, no two FIA contracts are the same. They're all different. They have different index options, different ways of calculating interest, different caps that limit your upside, not to mention the financial strength of the company backing the whole thing. You really have to compare all these details side by side to find a high-quality contract that's right for you.
Now, trying to navigate all those details can be pretty overwhelming. And honestly, that's where we come in. At The Annuity Expert, our entire job is to simplify this for you. We help people compare different annuities side by side to find the one that truly fits their goals. And our service is always completely free to you. You can give us a call at 770-755-1565 or learn more on our website at annuityexpertadvice.com.